So our host today is Mark Tickel. So he's a qualified chartered accountant and founder of A Fresh Accountants. He's been doing this for about 30 years. And I know that he's super passionate about helping business owners be less worried and less afraid of their numbers. And I'm really excited for this session specifically that he's created to help make it more clear of really what numbers are most important when creating and sustaining your business. He is very values driven, which I'm sure he'll touch upon as well. So for him, it's all about helping you create numbers that sustain your business, therefore increase the impact you're being able to do into the world as well. You can connect with Mark on Twitter and LinkedIn at Fresh Accountants. And I'll leave that there, Mark, and hand over to you.
Thanks, Sarah. So I'm going to share my screen in a minute and run through some slides, which obviously you can have copies of, and you can have the recording of the session afterwards. What I suggest, if you want to raise a question, is to take yourself off mute and just shout out, and we'll answer as we go along. Probably is the best way to go there. So if I share my screen now and go onto my slides, hopefully you can all start to see that. Can we see that now? Hello?
Not yet.
Ah, right. Why can I not see that? Okay, this is going to be a good start. Right. Okay, these things do work, don't they, on the thing, on my screen? Right. Okay, now can we see it? Right, so here we go. That's right.
Yeah.
That's okay.
Yeah, there you go.
Right. So like that. Okay, so that's my name. As I say, please reach out afterwards. Always happy to have a half-hour chat over Zoom, help you with any specific problems that you have. As Sarah said, my why, if you like, and what's on the back of all my business cards for the last 5 years is this, which is that basically, if we have better businesses, we will create better lives for the business owners and the employees and your own family, and that by default, if everyone has better lives, we'll have a better world. So, and that really starts with what I see in the middle here, which is better results. And better results come from better decisions. And the bottom is the data. So what I call the core financial numbers of any business. And that's what I want to try and get across during this session really, is that how the impact that they have. So if you like, COVID for me proved what I've been thinking for quite a few years. I mean, I've been an accountant for 30 years, but actually the last few years, I started to really realize how important small businesses were to not only the people that own the business, but their family, but just the broader community as well. Because, you know, the future of this country, the future of economies around the world is driven by smaller businesses now. The large multinationals are reducing in their importance because the small business owner is the key. So what I want to do is to ensure and work with clients, and accountants do, with all their business owners, to create the why. What do you want out of your business? Yes, it might be money, but more importantly, it might be time, or it might be time and money, or it might be time, money and freedom. And it's crucial whenever I discuss things with any of my clients that I figure out exactly what is their why, what do they want. I think if we're honest with people, when you start a business, you go, what do I want? I want some freedom. So they ask me, where's the freedom? Where's the fun of running your own business? Where's the Ferrari? And effectively, it's WTF, isn't it, is what we're saying there. So 3 key takeaways that I want you to get from this session, sorry, going back, are I want you to not be afraid of accounts. That's the key takeaway, I think, from today. Please don't be afraid of accounts. And more importantly, don't be afraid of accountants. I think, as I say, been in the profession for 30 years, I'm aware that without the software that we now have and the IT help in producing accounts, it was always difficult for me to have that kind of constant feedback with my clients. So I would probably be someone they came to every quarter for a VAT return, or if they didn't need VAT, then once a year for their tax return and their annual accounts. Nowadays, we're creating those numbers in real time. So it's important to connect with your accountant and ask them anything. So there is no point struggling, sticking your head in the sand and thinking this is somehow going to solve itself. It won't. And your accountant, whoever they will be, will much prefer it if you pick up the phone and say, Mark, I've got a problem. Can you help me now? Because if I help you sort something out in March, then it's far easier for me to do that than to wait until December when your year end is and you've done the same problem in April, May, June, July, August, etc. And you've had no handle on where your numbers are over that year. And then secondly, what the takeaway I want is for you to understand why the numbers are so important to your why. So it's brilliant that we're on the Good Business Club here, because you've all got, you're not just about making loads of money and being one up on everyone else. You're seeing the bigger picture for running a business, but everyone has a why, and that why will lead you to say, right, actually, if my why is I want to work 4 days a week, or I want to take my kids to school and pick them up from school, then we've got to create a business that allows you to do that, rather than a business that makes very little profit and then you end up working far longer than you ever expected to in order to try and make ends meet. And then finally, when we go through these numbers and 7 key numbers, it's to highlight the benefit of these marginal gains. Too many businesses go, well, this is what I did last year, so it's okay, I'm doing more or less the same this year. Actually, if we can just start to make small incremental changes to some of these key numbers, then actually they build on each other and create something really, really special through your accounts. So for small businesses, there's 4 key problems that I see. So business is complex. There's lots of forms to fill in. There's, that is complex, but actually there's also lots of software out there that can help you get through those complexities. Lack of cash and access to funding. If you don't make very much money, then it can be really difficult and money can be tight. So again, you need to look at your numbers. You need to see ahead when that cash squeeze might be coming and take steps. It's easy to get, relatively easy to get finance nowadays, but obviously not if you need the money tomorrow and tomorrow morning you ring the bank up. If you go to the bank and say, look, this is what I can see, this is my plan, I need some extra cash in a month's time because I'm going to take on a new employee, then banks love that kind of information. So you've come to them, you're seeing ahead where you need some money, and that will make that task and that application so much easier. Then a third problem that for small businesses have is that they have unreliable financial data and poor understanding of numbers. I'm an accountant. I like maths at school. I did economics at university. I became an accountant. I don't know what you 3 guys do, but you've got specialist skills in your area. It doesn't mean that numbers are your thing, which is fine, because an accountant can do it. And or the software now helps you so much that actually most people, I find, with a little bit of training, can keep a good handle on their key financial data. And then the 4th pillar for all small businesses, and which unfortunately very few do, is planning. Planning is everything. You wouldn't, I've heard it said that people put more planning into a holiday than they do into running a business, and obviously that can cause problems. So I'm hoping that out there you're using something like QuickBooks, Xero or Free Agent to run your core accounting information, because nowadays this kind of software, it can start at £5 to £10 per month plus VAT, up to the higher ends of the Xero QuickBooks, depending what you want, and VAT returns, etc., up to the sort of £25 per month plus VAT for the software. I mean, that is and Free Agent's actually free for those who bank with NatWest. But at that kind of level, that isn't a barrier to using this brilliant software that connects with your bank account. So you shouldn't be struggling out there using Excel spreadsheets anymore. If you are, then reach out to me and I can show you how to use this other software. I think next week actually Plus Accounting are doing something on Xero, so that will be worth either watching that one live or watching the recording, because it's, when you see it in action, it really does save a hell of a lot of time. And when you use that core financial information, then that gets you into what I call the really exciting stuff. So for every business, you should measure where you are now, and that's your sort of Xero and QuickBooks. Then you have a plan as to where you want to be, and effectively you're just trying to build a plan, a set of actions that bridge the gap between where you are now with your numbers and your business and where you want to be. And then accounting for that. So the 7 key numbers that we'll run through are basically measuring the sat nav, if you like. How are you getting on and getting from where you are now to where you want to be? And that's what we'll talk through over the next few minutes, 45 minutes, etc. So again, benefit of marginal gains. I'm sure we've all read the books. We've all heard about the British cycling team, etc., and Olympic rowers, and how everything was, does this make the bike run faster? Does this make the rowing boat go quicker? And if it did, they did it, and it improved marginally and sped them up. And they, we saw the success in gold medals that happened when they did that. Assuming they weren't using drugs, which was one of the things, but let's say they weren't. So here, if you do 1 to the power of 365, you still get 1. If you do 1 to the power 1.01 by 365, you see you go up 370% from where you were. So that's what 1% changes make over a year. If you do it every day and change something every day, brilliant. But if you spread that over 10 years, you could start to see the difference it could make to your business. I probably won't go through this in any great detail now for time-wise, but you'll see in the slides afterwards, if you look, that I've just done some number crunching here on the screen. And this is, a business that has a sale price of £100. It's got 100 customers, and to each customer, it sells 100 items. So if you could change those numbers by 1% and put your prices up to £101, have 1 more customer and sell 1 more item to every customer a year, you would turnover will go up here. And equally, if you change your gross profit percentage by 1%, then your gross profit on those higher sales would be this figure. Your fixed costs stay the fixed costs because that's what they are. And marginal gain, marginal costs such as salary, because you're selling more. But you can see there, by just doing these 4 changes to 1%, you've increased your net profit by 11%. So again, that's just a sort of, if you like, a teaser for what marginal gains impact can have on your business. I'm actually just going to put my dog out, sorry, who's pestering me, and he's going to go downstairs. Well, sorry, right, the joys of working from home. Right, so what we just looked at there is a profit and loss account, effectively. So we've seen, if we increase sales income and we do your gross profit percentage increase, then we've increased your net profit by £22,000. But actually, accounts are more than just your profit and loss. They're your balance sheet as well. And there's that resilience that, the last 12 months in COVID, for so many businesses, have had a massive effect on their balance sheet. So there's a lot of loans on their balance sheet. People are owed money. And this is the kind of resilience we've got to try and build back. So actually not just looking at profit and loss, but looking about how we start paying back some of these loans, whether we move some of these short-term loans into longer-term loans so that the repayments are manageable over a period, which will be good. So these are the kind of things you want to be working with your accountant with over the next 12, 18 months, 2 to 3 years, really, to sort of come up with a plan as to how you're going to build a stronger balance sheet if you've been impacted badly by COVID. So we're moving now on to these 7 key financial numbers. And what they want to do is what I'm trying to do is look, you've got your balance sheet and your profit and loss and cash flow statements, etc. And what we're trying to do is just say, look, we can't look at everything all the time, can we? So here's 7 key numbers that if you just measure and look at, they cover the profit and loss, they cover the balance sheet, they look at your cash statement and the efficiency of your business, and you're measuring how those move. So it's not the actual value of the number, it's how those numbers have changed over a period. So here are those 7 key numbers. You've got revenue growth, so that's your turnover, your sales, how that has changed, how that is changing over the year. Gross profit percentage, EBITDA, which effectively is a net profit percentage, revenue or sales per employee, a core cash target that I think every business should try and hold in reserve for those rainy days or those issues that suddenly came along. So, last March, a year ago, luckily my clients, I was building their core cash target, but some business I knew out there were being shut on the 22nd and had no money because on Tuesday, the 23rd, no money was coming through the till, and yet payroll had to go out on the 31st. They really had no, they literally were living from, as soon as that money came in the till, it was really going out a couple of days later in wages and stuff like that. So obviously, those that had a core cash holding were in a much stronger position to wait until the furlough payments came back from the government for staff, etc. Cash days is one we'll go through, and then business return. So I'm going to go very briefly through all of these slides and these 7 key numbers, and just give a brief overview of what we should be looking for and how you measure them. But again, there's more detail on each of these slides, so you'll get a copy of the slides afterwards if you want. I can send those on PowerPoint. And then if you've got any questions, follow up either at the end of this session, shout out, or of course, you've got my email details, so drop me a line and we jump on a Zoom call and we can go through any of these slides in particular detail, because every business is different. And so when I talk about gross profit percentage, some of you that might be relevant, others you might not buy and sell goods, you might just be a service kind of business. So by all means, talk to me independently and connect, and we'll run through them. So basically, revenue. So revenue is your sales, whatever people, takings, whatever you like to call it. And what you're looking here is, we just want it to increase, don't we? We want to see that, so we measure a figure in the first 3 months of this year, the turnover has been X, and if our year is to December, then we multiply that first 3 months by 4 and go, look, we're online for doing better than we did last year, or revenue is decreasing. And obviously, if we see something going up or down, then we understand why. We try to understand why that's happened, and we try to take action if we need to take action because it isn't going in the direction that we want to do. So most businesses want to grow, but it's not the be all and end all. And for you, as I say, when I talked about impact and results, I don't just always mean money. I mean, it could be that you're measuring the number of people that connect and use your services. So you're a provider of something that's got a social benefit. It's not raising cash from people in sense of your turnover, but you want to run a business that sees and provides your service to more people and helps more people. So that's the kind of measure you, particularly in your business, would be measuring. But as I said, we're looking at whether we can increase prices. So if we want revenue to increase, then the easiest way is to increase prices. 30 years as an accountant, I think most businesses undervalue their services and are very afraid of what prices to charge to their customers, and don't actually think that they can get away with increasing prices. But I would say to a pub client of mine, do you really think that if you put 1% on the pint of a beer, someone's going to suddenly turn around and walk out? No, they're not. So there is inflation going on. You will have to keep an eye on the costs of you producing that good. So if you're a supplier of services, then and you pay your staff a good salary and the cost of living is going up in somewhere like Brighton, then you have to make sure that your prices reflect that you're selling a service in Brighton where the cost of living is quite high, and you want your staff to be well paid for what they do. Then of course your customer will, as long as you provide the service that they value, will pay the price that I think you feel your services warrant. So again, always look first off to see if you can do something with your prices, etc. To increase revenue, you can look at your marketing, your sales system. How do you get new customers? But without also, it's all very important to realize that actually your existing customer base is probably the easiest and most lucrative way of increasing your turnover. So can I sell more stuff to my current customer base? Can I get them to buy more often from me? Which should be the kind of questions that you're asking yourself. And then you look at your business model. So again, in terms of revenue growth, sometimes it's important to understand what kind of products you sell and whether you want actually to chase certain products in revenue growth. So actually, if they have low margins, then they might take so much effort to sell something that actually you look at your accounting figures and your key numbers and you go, well, yes, I'm getting growth there, but actually on the bottom line, I'm doing that at the sake of squeezing my margins. So actually, I want to now concentrate on some other part of my business. So you distinguish as much as possible your product and service mix. So effectively, you have sort of 2 or 3 different profit and loss accounts. Here's my profit from selling, beer. Here's my profit from selling food at the pub. And actually, if they both grow nicely, then that's great. But if one actually is a hell of a lot of work and hardly gives me any money, and I just can't seem to grow my food service, then I'll carry on doing lots of beer work and then try and change the product I sell here as a complementary one. Gross profit percentage is the second key number. And how I would describe gross profit is when you buy and sell a good. So, if you bought apples and sold apples, if you buy an apple for £1 and you sell it for £2, you're making 100%, 50% gross profit margin. You sell it for £2, less the pound, it's £1. You want to keep an eye on that when you're buying and selling goods, because sometimes the cost of what you're buying in is going up. So, it might be the exchange rate. If you're buying apples from abroad and suddenly those costs are rising, your margins are going to be squeezed. So that's when you need to make, change your prices, increase your price back to the gross profit margin that you need to achieve in order to sell as many apples as you do. And when you sell as many apples as you do, to cover your fixed costs and give you the profit that you want from your business. So effectively, there's a great book that I've read called Profit First. And sometimes in business, it's very easy to say, here's my sales, here's my expenses, and what's left is profit. And effectively, you as the business owner just get left with whatever there is at the end of the day. And actually, if you turn that around and said, actually, this is the profit I want to make, these are my costs, this is my sales value that I need to achieve, and the margins I need to make in order to achieve that profit, then it's a different mindset you get into, and you concentrate then on the sales and the gross profit margins. Again, as with sales, the key here is to try and differentiate as much of your service as you can into distinct parts, if that's possible. If you do the same thing, that you don't need to do that. But sometimes you might find, some businesses find, wow, actually, I make a really good gross profit margin and a good gross profit on doing this type of service, and this other one, which I spend a hell of a lot of time and effort on trying to achieve, doesn't actually give me very much money. So would I be better off just reducing that down, offloading it to someone else to provide that service to my customers, and concentrate on this more profitable element of my business, and my life would be a lot easier. I'd work less hours, and I might even actually make more money as I increase the revenue from there. So split your business into different bits if you can, and don't be afraid to, as I say on my first slide, it's all about your decisions. I want people to make better decisions. In business, you are constantly making decisions, and sometimes those decisions have to be, right, I better not carry on doing what I've been doing before, because actually I can see that I'm making loss, or that start of my business is just so cash needy that it's dragging all the cash out of my business and making my life stressful. So I'm going to cut down on that and concentrate on what I like doing, what makes me more money, etc. Gross profit percentage is a good measure then of efficiency as well, and technology, how you can use technology to do things better and quicker, and then make more money. Systemization, I'm sure you've all heard of that and read books about it. I mean, that's the key. It's sort of, this is how we do things here, and you write down a system, and so that when your first employee comes along, here's the handout of exactly how we do things at a fresh. When someone signs up at a fresh onboarding, these are the tasks we run through, and therefore that's a system, and someone else is, I employ, follow the system as if it was me. And that, a good systemized business has a greater value for someone who comes along to buy it, etc. going forward. EBITDA, it's a very long and complicated name. EBITDA is what people who eventually buy businesses always want to look at, and how I would describe that as is your net profit. So you've got your sales less your core business costs, that's your gross profit, and then you've got your overheads like your telephone, your heat, your lighting, your interest payments, etc. What EBITDA is your earnings before, so the EBITDA stands for earnings before interest, tax, depreciation, and amortization, which is effectively depreciation on goodwill that you might have bought. And what that allows is if you calculate the profit before deduction of those things like interest and tax, then you can compare businesses with businesses. So you can compare a business that maybe has a lot of fixed assets and therefore a high depreciation with a business that doesn't need a lot of fixed assets in it. So that's why that figure is used. But effectively, it's net profit. And again, net profit is good because we want to see it increasing, I assume. And we look at that as a measure of how successful we are as a business. That's, if you've got your wages in before net profit, then your wages are there. But net profit sometimes is your wages for most, for a self-employed business, that's your salary. So you want to measure that and make sure it's going in the right direction that you want. Again, the kind of discussion points you'll have when you're thinking about your net profit is you're looking to see if you can reduce any costs. So, the easiest way to improve profit, as I said before, is to increase your sales price and obviously sell more of the stuff. But equally, you could reduce your expenses and then your profit will go up. So, think about that. Is there any expenses that you COVID was actually, one of the positives from COVID when I worked with my clients is initially back in that early days of March and April, we went through, if you like, the normal monthly expenditure and said, right, do we really need that? And it's amazing how many people had signed up to software and went, actually, no, I don't ever really use that. Or, yeah, I probably did sign up to Adobe and got the £18.99 monthly fee, but I don't really use it and I could cope with the free one. And so, it is helpful sometimes just to go through what you spend your money on. And, just because it's been set up as a direct debit and automatically every year it's renewed, do you need it? And that's the best way to increase that area there. Revenue per employee is a really good one, and one you're interested in when you're thinking about, do I make this big new step and employ more individuals? Another key worker in the business. And what kind of revenue, what kind of sales income do I need in order for me to justify that expense of getting an employee in? It's slightly different from what's the profit from employing someone. You're just you're doing your whole total turnover divided by the number of full-time employees. So you're not being specific to one individual person and putting pressure on them necessarily, but you're saying as a business, this is what we're sort of heading for. This is the kind of business model we should have, and different businesses have different sort of levels of incomes. Some might have huge figures with lots of noughts on them. Others might be 60,000 per employee is sufficient for their needs. So it's just a measure that everyone is working, and you can look at efficiencies there. You can look at using technology, and actually by using technology, you can create the better world for your employees as well. So it's not a case of, right, now I've used technology, so I get rid of someone. It's a case of I've used technology, so actually I'm going to be one of these lovely businesses that says every other Friday is a day off, or everyone can have their birthdays off as a holiday in my firm, because that's what we do. We concentrate and make things efficient and have a really happy team. And you've got happy employees, happy team members, then it normally follows that you have a good, sustainable business. Look at their core cash target is one I think I touched upon at the beginning when I talked about what happened when suddenly the wheels came off last year and everyone went, oh my God, the doors have been shut. My hotel clients in Wales, suddenly, I think it was for them in Wales, it was Mother's Day. So yes, Boris stood up and said, we're shutting on Monday, but effectively he'd been telling people not to go to the pub or outside and mix with people for days before that. So everyone was really starting to suffer by the time the proverbial hit the fan. And it was actually those people that said, oh, thank goodness, I had a little bit of a buffer cash. And what I calculate that buffer cash should be is all the tax that is payable, so your VAT or your PAYE, etc., plus 2 months of your overheads. So that if, and let's hope that it never happens again, but if your sales suddenly stop tomorrow, you'd have some cash there that could keep you going whilst you try to correct, either reduce those overheads going forward if you had no income coming in, or last year we had, suddenly there was grants coming from the council that arrived eventually, quite quickly really, and then furlough payments for your staff. But in that interim, you needed some cash to pay those expenses that you had. So a core cash target is something that you should try and build up over time. And it's basically just the cash you need in a business to keep it sort of ticking over. It's not the same as loans from banks, which actually you would try and that outside capital that you might try and get because there's a particular project. So you say, right, actually, I'm going to expand my business and I want a new piece of machinery or something like that, or I want to take on a new team member, but I appreciate that I'm going to spend money on them, train them for the next 3 or 4 months before I start to see the benefit of increased sales coming through, or I want a new website that's going to increase sales at some point in the future. So I go to the bank and say, can I have some funding over a medium to long term to finance these plans? So a core cash target is just sort of working capital that you have in a business. And then there's some key points there about, again, systems and product service mix, etc. Cash days. Cash days is a measure of how long it takes cash to sort of move its way through your business. So again, an example you might have is, well, Apple's is not very good, but say I sold trainers. So I go and buy trainers from somewhere abroad. I have to make a payment up front. So my cash has gone out to the supplier of trainers. Then there is some period when they deliver them, and then they'll come into my stock cupboard. And then there's going to be some period until I sell them. So it's basically measuring that I bought some trainers for £50 worth of trainers, and then eventually, however long that period's going to be before I effectively sell them and get cash back, I'll get more cash back than the £50, hopefully, because I'm selling for more than I bought for. For that £50 has to be in the business for a period. For some businesses, that's a very long period. It can be up to 60 days. So, you might have to buy a stock from a supplier. It takes a while to be sent over on a cargo ship. Then it goes into stock, and then I've actually got to try and sell it. And then maybe I don't sell it to Joe Public. I sell it to a supplier, and they take 30 days to pay me once I've raised an invoice for them. Then you can see you can have quite a long period. So it's important, if you know your cash days, that again, you're talking to the banks, you've got a cash flow statement that mirrors that in the way you work, and that therefore, you can either try and do things to reduce them. So you might invoice quicker than you normally do. You might try and chase for that customer to pay you earlier than 30 days credit terms. You might not give 30 days credit terms, or you might give an incentive for them to pay early. If they pay early, they get 5% discount or something like that. So, it's just a way of moving that cycle through. I mean, there's a very good saying that you can grow broke, because actually, if you have a very long cash cycle, then off you go and you're really, really busy and you buy loads of stuff and you will sell it eventually. But in that interim, you're spending money out, and that's going to take quite a while before cash comes in, and you haven't really planned for that. And suddenly someone says, right, I urgently need payment, and you haven't got the cash in the bank, you spent it all on stock. So again, very important that when you're measuring these key numbers, you're looking at trying to reduce these cash days, and or if you have a set cash day figure, it's going to be 30, 60 days in your business, that everything you do in your cash flow reflects that. So yes, brilliant, I'm going to increase and grow my business and open another shop and sell more trainers, but I'm aware now that that's going to take a lot of cash, and it's going to take a while before that cash outlay starts to come back through again and we get the churn. So that's cash days. again, inventory whip system. So again, if you had a stock system, you'd want to make improvements in that so it's really efficient. And debtors, creditors, again, chasing up people who owe you money works really, really well. Too many people just send an invoice out to someone and cross their fingers and hope they pay. Actually, people want to pay you. They normally do. If they've got the money, they will pay you. And it's about making it, that payment of your invoice, so much easier for them. If you make it easier for your customers to pay, you know, I send out invoices, I set up Go card lists for my clients. It's easy. If I waited a whole year to send them one big invoice and then ask for the money, I'm asking for a large amount. Whereas actually most people nowadays buy things on a monthly sort of direct debit, don't you? You know, you buy your Netflix, you buy your Virgin Media on a monthly amount. You know how much is going out every month. So most of your outgoings are probably the same figure every month. And it's in bite size, it's in more manageable elements and costs. And I think that's easy for most businesses to deal with. And then finally, the seventh number that you want to look at is what's called the business return. And how I would describe that is basically means, look, when you run a business, you're doing a job. So you're physically going out and you're working 30, 40, 50, 60 hours a week on a business. Now, even if you paid yourself the minimum wage or the living wage or whatever, that's an amount you should get just because you physically work so many hours. And the business return is over and above that. So your business should pay you the going rate for the work that you do in the business. And then on top of that, should be providing businesses with a return, an extra amount of money, because you are the owner of the business and you're the one taking the risks and putting in extra time and money and effort into running that business. And sometimes, you know, a small business owner needs to see the wood for the tree. Sometimes I have in the past said to people, look, this is your profit and it's not how many hours do you work. And when we sit down and actually discuss the effort and the time and the hassle and the fact that actually a lot of the bits that they spend their time doing for their business, they don't enjoy doing, then actually they would be better off probably maybe closing the business or reducing the size of the business and going out and getting a job and getting paid a salary with a holiday pay and sick pay and all of the benefits you get for being an employee of someone else. So it's important to measure that business return. For most people, it's great news because, you know, it just is another sort of pat on the back for running a business. You know, I want to see my clients have a good business return of 6, 7%, 8%, 10%. Obviously, if you make a huge business return and you're a very, very successful business, what you're going to find is that either someone's going to come knocking at your door trying to buy your business because great, it's very successful, or you're going to have competitors and therefore they're going to reduce that business return. So it's a really useful number to measure, to just confirm that you're doing the right things, but also if you're not doing the right things, to show you're not doing the right things and to say, actually, you're working way too hard, you know, and your profit from this business, your salary is not even, you know, maybe touching £12,000. I've seen people and I've said, this is what you earn for all the work you do. And then we have to reassess whether the business will ever make them the money they need or deserve, or we change things and get the return that they want. So, so as I said here, simply put, it measures if the business is worthwhile or whether the owner would be better off investing their money, time and effort elsewhere. And that effectively is the business return number, the seventh of those 7 key numbers that you should be measuring. Looking at time-wise now, I think I'm probably going to the end, so I'll skip through here. Now, one of the things that I'm a member of is B1G1, and if anyone wants to see a really good talk, Antoinette did one last week where she ran through B1G1 and what it does, and basically it's a giving platform, and I think there was Tom Shoes was one of the most famous ones, wasn't it? You buy a pair and they give a pair somewhere else. This is actually saying when I do something, this is what happens as a result. I make a donation somewhere else. So I said at the beginning of this that for everyone who turned up, we give 2 days of education, because I'm hoping you've learned something from this. And what you've learned is probably a seed that hopefully will grow over weeks, months, years ahead as you run a business. and you'll think, right, yeah, actually I want, it might not be that for the next 2 months you'll be able to look at these 7 key numbers, but that's what you should be aiming to be able to produce. So use something like Xero and QuickBooks, concentrate on that for the next few months to make sure that your actual key numbers, so you know where you are now, are really good. And when you know that, then you move on to the next thing, which is to build a plan. And then you're trying to bridge the gap between where you are, where you want to be, and then how do you measure how you're getting on that journey as you measure these 7 key numbers. So I will now try and stop sharing my screen there, and then share very quickly my other screen, if I do this right. Sorry, share screen there. B1G1, I think I was in here. Oh, come on. Oh yes, I know what I'm doing there. Actually, I'm not sure I'm going to be able to do that, am I? No, I'm not going to be able to do that. Right, stop sharing that screen. But I will afterwards make a donation through the B1G1 platform. I'm trying to do it here now and show you how it works, which is really good. Again, I really recommend that you look at Antoinette's talk last week, because I think that was really, really helpful at showing how that platform can work, and how I think actually, as well as being something that's really good and gives back to communities around the world, it actually is a really, really good business model. So I saw this, and Paul Dunn and Masami, who run it, gave a talk for a load of accountants, and it's a room, well, in the good old days when you could fill a room with accountants, and it said, right, there's 2 coffee shops, one in one corner of the room, one in the other. And this coffee shop says for every coffee you buy, 1p goes to water in an African well, towards an African well money. And this coffee shop just says we sell coffee. Where do you go? And the whole room just obviously went to the one where, why not? The coffee's the same coffee, but you just get a better sense of something happening. And it's small in their cents, and it's all in dollars, but some of these things are just 50 cents. So it's not, you don't have to spend lots of money, but for every coffee you measure how many coffees you sold a day, and then you make a contribution and you put it up on your shop window. I think that is not only a good thing to do, but it's a really, really good business model to do if you've got 2 coffee shops on the same high street, which everywhere in the world has got more than 2 coffee shops on the same high street. So I'll have a quick now look on chat.
Yeah, thanks, Matt. There's no questions in chat yet, but I was going to say, if anyone wants to come off mute, or pop it in the chat now. I have also got a question if no one else does, so I'll see if anyone else wants to come off mute. Was there any numbers that anyone wants Mark to focus a bit more on, or any questions that have come up from that? Dave just said that was great.
I had 2 questions.
Mm-hmm.
Yeah, sure.
Both a bit not really related to each other. Useful to kind of get that sense of a target with some of the numbers, so that I do, in terms of having cash to cover 2 months. But is it useful to benchmark externally in terms of figuring out, rather than having our own targets, getting a sense of how realistic those targets might be and how far they can be done? And the other one is another number, perhaps, and this is something that I kind of come across more generally across enterprises of all types, particularly in this country, is about the number on our intellectual property. Because it's our IP that most of us are trading on, and yet it's our IP that we're not capturing or recognizing in any way in our accounts. So is there something about a number that could go on that, or is that within the kind of 5-10 minutes we've got left, maybe a bit too philosophical for a call like this? If it is, that's fine.
No, right. In terms of benchmarking is really good. And I think what's going to happen with the software, and I was on a course, I think it was about 3 or 4 years ago, when I think on the QuickBooks they stood up, and the guy who came over from America said this is where they're aiming for. It is that basically as they get more and more data in about so many more businesses, they are going to effectively have naturally just key data. So if you are a coffee shop in Brighton, at some point in the future, they're going to just have all this data for every coffee shop that sells coffee in Brighton, and they're going to suddenly say the gross profit margin for coffee shops in Brighton is X%. And then you as a business should be going, wow, I'm doing really well because I'm much better than that, or I haven't got that. What do I do about it? I mean, it is difficult, and you're gonna, you're just gonna have to wait for that key data. At the moment, there isn't data out there. There's some, years ago, there was some organisations that charged lots of money and said that they had benchmarking data, but I mean, it was at such a cost that most firms didn't bother buying the information to see if it was correct or not. So I don't know. I mean, at the end of the day, you've got to start you're comparing and benchmarking with where you were this time last year, I think, is the best thing that happens. And if you're or where you were last month, and it's so yes, ideal world benchmarking, but I think in reality,
the only data set like that I'm aware of out there at the moment is called the Cappuccino Index, which is created by Power to Change, who, if you're a community business, community enterprise, they do seem to be generating some interesting data sets around some of those benchmarks, but that's very narrow and prescriptive. At the moment, it doesn't kind of open it up. Yeah,
and in terms of intellectual property, well, yeah, I mean, that you're right. That's a key asset, and accounts, in a way. I mean, so I've been an accountant for 30 years, but only in the last few years I really get excited about accounts now, because actually you're with the software, you're measuring what's important. So I always say to someone when they say what needs to be in accounts, well, yes, the government comes along and gives a one size fits all and says, put sales up there and overheads here and tax down there, and this is a financial set of annual statements, and this is where everything should be. But actually, I sit down with my clients and go, right, what do you want to know in more minute details? In cost of sales, do you want to know labour? Do you want to know labour by location? Do you want to know, whatever? And we just create lots and lots of different headings. So I agree that, great, you get value as in maybe to value the intellectual property, what have you created over time? I suppose you're measuring that by looking at your turnover income, aren't you? You're saying, I started a business, I started off and I managed to sell £50,000 worth of courses. Now suddenly I've created something that everyone loves so much that, wow, I'm now selling this, and I can, fill a room with people who want to come and listen to me. So you're measuring in that sense, and then someone else comes along and goes, right, you have created something that everyone wants to listen to, buy a bit of software, and that's been valued then, isn't it? Because of what it does to your sales and how profitable you can be from selling that service. So yeah, no, good questions, but not something that's actually in accounts per se, unless you buy it, because obviously if you buy it from someone else who's already created it, then there's a value there. It's the purchase price. It's been set in stone on the day that you buy it. You paid 10,000, 50,000, 100,000 for that intellectual property when you bought the business. So that's good. As I say, the key is with all of these things is probably just to get your Xero and QuickBooks right. I mean, I love talking about what we can do and how we can do plans, but then too many businesses that ring me up go, oh, I say, well, what did you make last month? Don't know. Well, here's an Excel spreadsheet and it's all over the place. And there doesn't need to be that anymore. No business owner really should be sort of losing sleep at night worrying where they are financially. It's so much easier now just to connect your software to your bank account and to have a real picture that you can go into every day and go, right, this is where I am. I do owe PAYE in 3 weeks' time, and this is the figure that's got to be paid. This is the figure that's got to be paid for VAT. And if you start to know that, then it takes away the worry, because you can do something about it. I'm not saying that you're not going to be happy that you owe all these people all this money, but we've got bounce back loans that might start being repaid. If you look and you can't repay them in the time scale that the banks want, then you take advantage of these new offers that are coming out to take a holiday for 6 months and plan that into your system. So, I say to everyone, everything's sortable. Do not panic. Do not lose sleep over things. Do not, despair. Just look at the numbers and talk to someone about it. I think it's the old saying, isn't it? Problem shared is a problem, if not halved, then at least reduced, because you're not the only person. There's loads of people out there with bounce back loans that are going, how do I repay this bounce back loan? So ask, and people will come up with a plan, hopefully, to help you get through that.
Great, thanks, Mark. Does anyone else have any other questions? Shiv, Matt? You're good. Super. No, thank you very much for that, Mark. I think as also someone who works with very early stage businesses, I think specifically that last number about business return and actually look at the viability of the business, really understanding the amount of effort that needs to go, not just as us as entrepreneurs, I guess, but in long term, and understanding actually the viability of the business model early on is a really good one to be kind of tracking and looking at how you can shift that. So thank you very much. And if you're we're happy to share the slides in the Slack channel, then what I can do is link to that when we've got the recording up. So when people go to the recording, they can link straight to the Slack channel and access those slides as well. So that'd be brilliant.
And then if anyone has any, if anyone started using something like QuickBooks, I'd say that I think Plus are doing one on Xero, aren't they, next week or something? Which if you're on Xero, I really, recommend you try and log into. But I do QuickBooks as well with clients. So if people are using QuickBooks and they want help with that, then put your hand up and we could run a course, and maybe good businesses small businesses will want help with that as well. But it is just getting started with some of these numbers and then using them as KPIs, I suppose. It's good. Yeah.
Awesome. Thank you, Mark. I'm just going to bring the session also to a close.